morning. Let me start out by thanking PMS Bazaar, Mr. Palarajan and his team for organizing this wonderful event for the second time in Dubai. I think the amount of planning that goes, I think that he met me more than 4 months ago to discuss as to how this whole thing has to be organized, and they have been following up on all the actions that needed to have this wonderful summit for the second time, and I must thank you and your team for the wonderful coordination that you have been doing. And my good friend Mr. Vikas also has set the context for the meeting, so it makes life easier for all of us to take this discussion forward. So before I start the session, I would like each of the panel members to introduce their companies. I think you have heard their individual introductions. So please tell to the audience as to the company and what sort of products and investment propositions that you manage. Let me start with Mr. Vipul.
Good morning, everyone. I represent Magat Capital PMS here. We offer a fundamental style-based PMS. We have two approaches. One is the multi-cap approach, which we call as value for growth approach. And the second one is mid-cap and small-cap focused approach, which we call as future stars approach. Broadly, as a firm, we work primarily on fundamental style of investing with heavy thrust on bottom-up investing. And we also overlay a heavy dose of behavioral finance in our approach. In terms of investment philosophy, we are heavily focused on risk management, which means that we are very conscious of capital protection at the portfolio level. We are very conscious about margin of safety in individual stocks. We look broadly at investing as a probabilistic game. We like taking counter consensus calls, especially if you have done thorough research. And in terms of process, we believe that we are fairly flexible in our approach. In fact, we feel that we should be having strong views held loosely. So this means that we are not quality, we are not value investors, we are not growth investors, we are not even momentum investors, or for that matter, dividend yield investors. What instead we are focused on in figuring out the gap between a stock's fair value and the stock price. So our entire analysis is driven towards figuring out what a fair value estimate should be. And that's how we take our calls. Going into the two approaches, very briefly, the value for growth approach, the multi-cap approach, here we try to look at companies which are delivering good return, good earnings growth, at the same time which have healthy return ratios and which are improving further. So basically, we are looking for good companies at a fair price. In the future stars approach, again to highlight, this is a mid-cap and small-cap focused approach. What we do here is we are looking for taking some well-calculated risk and delivering superior risk-adjusted returns over medium term. So that would be the kind of introduction for it.
Mr. Bhavin, you could briefly introduce your company, please.
I'm Bhavin. I did equity research and equity investing in the context of the global markets, in the context of Asian markets, and in the context of Indian markets for 20 years before starting Samiksha. So essentially did 3 startups, all eventually ranked #1 in their respective fields. And so I thought there was something I have done to put, and I wanted to put it to use. So the hypothesis I had was that, I should be able to outperform, other investors, but then only this activity would make sense. So whatever savings I had, I put it into my fund, and that continues to be the case. I don't have any exposure to direct Indian equities outside any of the Samiksha's funds. And that commitment continues to be meaningful even as our assets have grown. What is unique about us is that we have grown from word of mouth. Even today, 90% of investors have come to us directly based on word of mouth. So one investor telling another investor about our performance. We invest across market capitalization. So we are, flexible in market cap strategy. We have deep investments in people and technology. So the technology aspect is something I think is very unique to us. We have in-house software development team that basically helps us develop methods and processes that are very detail oriented, but at the same time, using technology, we are able to handle that in an efficient way. And using this, we are trying to find opportunities in Indian equities where risk reward is superior and participate in India's growth story. I think results have been encouraging so far. I think we have been able to significantly outperform the benchmarks as well as have been consistently ranked in top 10% for 3 years now for the 5-year period that any 5-year period that you look at. So on a rolling 5-year basis. And we offer investors opportunity to, we just have one strategy. So I have one brain, so one strategy. And we offer investors opportunity to invest either from outside India, so through Gift City, so you invest in dollars and take money back in dollars, or through the domestic channels that are available if anyone has money in India. So yeah, that's about Samiksha Capital. Thank you.
Good morning, everyone. I'm Bhavik from Abans Investment Managers. Abans Group is promoted by Mr. Abhishek Bansal. We are headquartered in Mumbai, and the brand Abans comes from his first and the last name. And so we have, PMS business in India. We have AIF license from SEBI. We also have an NBFC, so we are regulated by RBI. As a group, we also have a broking company in London, so we are regulated by the FSC. We also have a fund structure in Mauritius. From 2005 till 2017-18, the group's focus was only on the proprietary fund management, right? And this was done under Abans Holdings Limited, which is already a listed company now with a market cap of almost about 1,600 crore. That's about $200 million. And net worth of close to about 975 crores as of the last audited result. So that's about the group. And at Abans Investment Managers, which is the subsidiary of the listed company, that is Abans Holdings Limited, we offer multiple alternative investment products. So we offer PMS, both the dollar version of the PMS as well as the rupee version, which is like the PMS accounts. We also offer a dollar denominated arbitrage fund, which does arbitrage in global commodities and currencies through our Mauritius vehicle, which is Abans International Limited. It's been for almost 7 years that the fund has delivered close to about 8% net returns in dollar terms with a monthly liquidity and no exit load, no lock-in period. We are also very active in the Indian market on the market-linked debentures. The structured products, as most of the people know here in the developed market. And despite of the change in taxation, we have designed the products in such a way that it makes sense to invest in these products. Even if somebody is in a higher tax bracket. And we've done a lot of innovation in terms of a lot of stock link structures, like how I'm sure in UAE people know that there are a lot of stock link, global stock link structure products that you get, right? And to make it available to the NRI stroke offshore investors, we have wrapped it under category 2 AIF also. So from time to time, we come out with Cat 2 AIF, which in turn, invest into these kind of MLDs, giving you more predictable returns. Through the underlying, market-linked debentures, as it is known in India, which are principal protected products, right? So that's what we do.
Yeah. Hi, my name is Anirudh Garg. So we are a 30-year-old investment house. We started in 1992 when my father, Mr. Rajneesh Garg, he was given a ticket for Ludhiana Stock Exchange, that is in Punjab. So for him being a chartered accountant and a company secretary. So he's been a very successful investor since then. I came at a very interesting point in the markets. I joined in 2007, and that India shining story was being sold that time. Things were great. I was studying in the UK. I remember we used to get up at 3 in the morning and just aligning yourself with the Indian markets. And money making was so easy that time that you used to get up and like make 4-5 lakh rupees every day. And things were pretty easy. And they seemed easy, and then set in the 2008 financial crisis. That financial crisis, I lost everything that I had earned in the last 6 months of 2007, but made one point sure that let's go to the very depth of it. How we did our chartered accountancy, how we did our graduation. Let's get to the facts. And then we formed a research group in which we interviewed a lot of fund managers, a lot of, I would say, retail investors. And there were four prime, I would say, conclusions that we took from that research that we did. And they today serve as the way through which I can explain Invasset to you. The first thing was that capital is the only real thing in the market. Profits kal aane hain, losses kal bachane hain, but capital is the only real thing in the market. So preservation of capital is must. Secondly, as important as is the preservation of capital, equally important is the appreciation of capital and generation of alpha. If on a 3 to 4 year period you cannot generate alpha for your clients or for yourselves, then you need to go back to the drawing board. Third, as human beings, we are prone to biases. Biases, the recency bias being the more, the most common one. The what has happened to you in the last 5 years would dominate your psychology or your decision-taking ability to what had happened in the 5 years before that. So one thing that I have learned in these 17 years is that markets, they punish biases like anything. When trends change, when things change overall, markets, they punish biases. And last but not the least, as Vikas sir said, change is real. When we get too comfortable in the markets to a particular investment style or to a particular strategy or to a particular, I would say, sector or a particular way of thinking would be a more broader thing to say, then you have to underperform. So make a strategy, make a way of thinking which is adaptable to everything. So at Invasset, we would say that we are one of the truly multi-cap, unbiased PMSs looking for alpha generation in a 3 to 4 year period while protecting your downside to not, the target that I keep for myself is not more than 20%, not a fall of more than 20% should come. And at least you should do 1.5 to 2x of what the benchmark Nifty does. So this is what a broad scope of what Invasset does. And we have just one scheme. As Bhavin sir said that so how I see it is that I've not been able to get a better scheme than the one that we are already implementing and using for our clients. So yeah, just one scheme that we are focusing on, the Invasset Growth Fund. And that is what I explained to you. Thank you.
Well, thank you for the introductions given by each of the panelists. I must say that in terms of structuring this event, it has been very carefully done. I think, and the first topic that we are going to talk about today is the secret of superior returns from India's top performing portfolio managers. I think, end of the day, what matters is the returns that you're giving to the investors. And what better way to start the first panel when we are getting deep diving into the returns, returns of the overall fund management industry. And we have a panel who has spent years in this business, and we are going to find out how returns are going to be derived now and in the near term as well. You know, this is a quote that I've been wanting to say for quite some time. It is, in the short term, the market is a voting machine. In the long term, it's a weighing machine. This is a quote given by Benjamin Graham. And when I never got to use this quote because I felt that this is the right forum to do it. Because to paraphrase this quote, I think, and a lot of this is going to derive from this quote for this session, is that in the short term, when you go for rote, you're with short-term view. You're looking at what is the present inflation is this, my price of household items is this, my future. You don't see for more than a 1 or 2 year sort of a perspective when you go for vote, whether it is in your elections or whether it is in any body or organization that you go for a vote. But in the long term, it is a weighing machine. Why do we say that? I think from an India perspective, I think it was a very interesting statement I read in one of the returns which caught my attention is that it says from fragile 5 to first 5. That is what India has happened in the last 10 years. So 10 years back, what were we? A fragile five country. Today, what are we? We are a first five. So the transformation in 10 years has been dramatic. When you go back to 2013, I remember as non-resident Indian, that was the worst year for the rupee, depreciated close to 20% that year. From a country perspective, inflation was at 10%. The market cap was around 1.8 trillion, if I'm not mistaken. Current account deficit very high. I mean, we had whatever the macro negatives that one needed to have was all there. But come back, just roll back for 10 years and see where we are today. Your current account deficit is the last data I read was about 1.9%. Your forex reserves, which was about 250 billion, 260 billion, is now about 560 billion today. Inflation is at 5%. Your interest rates are 6.5 compared to what it was 8, and your market cap is 4 trillion. So on a market capitalization alone, we have doubled in the last 10 years. I mean, I don't have to talk about returns that has been delivered over the last 10 years, but from an average perspective, 100,000 or a crore rupees invested 10 years should ideally have been 3 times by now. That is the sort of minimum average return that one investor should have made from India in the last 10 years, given whatever phases of the market movements that happen. So when I say the weighing machine is the 100 going to 300 in 10 years. So that's how your bank balances has increased over a period of time. And I think from a long-term perspective or any 5-7 year rolling perspective, I think Indian markets has never failed to reward its investors. So that is where the context in which we are getting into this topic. And this is becoming a more relevant because 23 has seen a period of high returns. Even though the broader markets have gone up only 20%, the other sectoral markets have gone up 40, 50, 60. I think we all know of these data points. So my first question to the panel is, okay, last 1 year or on a 3-year rolling perspective, we have all delivered great returns. Now, first is, what has been your approach to deliver these returns, and how is it going to change, or how do you look at it for the next 3, 5, 7 years time from now? I would like to start with Mr. Vipul next.
Yeah, so we focus, as I was saying, on 3 important parts in our process. The first one is the fair value calculation. We look at the numbers quite a lot. We try to understand the business from a bottom-up perspective. We try to see the key business variables. We try to forecast them. We try to put proper assumptions. And then we see what are the kind of cash flows that the company can generate over a sustained period. And that's how we try to figure out what is the rough fair value. And then we assign probabilities to various scenarios. And we work a lot with the scenarios. The second part of our process is the portfolio construction process. We term it as facts box, FACTS, facts. So basically, we try to make 5 categories of stocks. So any stock that has to come close to being considered for getting into our portfolio has to fall into one of these 5 categories, even if it is doing very well on the front of gap between fair value and the stock price. So what are these categories? F stands for fast growers. So we are in this category, we are looking for stocks, for companies that can deliver 20% plus earnings growth over the next 4 years. The second one A stands for asset plays. So these are the companies wherein, for some reason, the assets that are visible in the company, the market is not assigning proper valuation. So we try to figure out the reasons why is the market not assigning any value to that or a fair value to that, and what can change for it to change its stance, for the market to change its stance. So these are the asset plays for us. The third category is cyclicals, which obviously consists of commodity stocks or other stocks whose revenues are cyclical in nature. Obviously, in this case, we have to be very conscious about the position in the cycle of the underlying commodity. The fourth category, T, stands for turnaround stories. So these are companies which for some reason have been making losses, even though earlier they were delivering good returns and good margins and good growth. But now, if we see that there is a potential of them doing a turnaround, if they start making profits from here, then we'll be interested in taking some position in these companies. And the final one is stalwarts. S stands for stalwarts, facts box. So these are companies which have a very solid track record and where we can have conviction that for the next 8 to 10 years, even if the growth is slightly more modest, let's say 12, 13% earnings growth, but you can have visibility for the longer term. So these provide stability to the portfolio. So this is how we try to diversify risk reward and try to optimize it. So this is the second part of our process, which has helped us quite a lot in the last 1 year and earlier also. And the third part is what I was talking about, the behavioral finance framework that we use. So this is to reduce mistakes in our process. We want to keep aside the emotions. We try to take more rational decisions. And as human beings, as investors, we are all prone to these kind of cognitive biases that are there in our system, in our mindset. We try to see any decision that we are taking at any point in time, let's say buying a stock, selling a stock, holding a stock, or avoiding a stock. So any kind of decision that we are about to take, we try to test it on parameters of behavioral finance. We try to figure out if there's a chance of any of some cognitive bias coming in our decision making. If there are chances, then we try to see the extent of that bias and we try to document it. So we try to see if there are some parallels from the past, if there are deviations from the past in our decision making. Let's say if we are falling in the trap of sunk cost bias, we try to see how to avoid it. And if we realize that, yes, there is an element of this sunk cost bias in our decision that we are considering to sell a stock, then we'll go back to the basics. We'll go back to a calculation of the fair value again, and then we'll take a fresh call. We'll change the assumptions. So this is how we have been doing it so far. From here, in my view, some of the indices have become slightly, in fact, overheated, especially in the mid-cap and small-cap space. But that's for the indices. In the same space, mid-cap and small-cap, we see there are some pockets where there is a lot of money on the table even now after a decent run-up, because the valuations are not stretched at all, especially given the way some of these companies have changed, and the sectoral tailwinds are also working for them. So what we are doing here is that we are very conscious of what can go wrong from here. So that analysis is up there for us. We are trying to stretch the assumptions, as in if we put very pessimistic assumptions, pessimistic but still close to reality at times. So those kinds of assumptions we are plugging in the models, and then we are seeing what could be the fair value. And we are also assigning higher probabilities of these bear case and bad case scenarios to see how much can we lose if something goes wrong. So this analysis also helps us a lot. And finally, we are at this juncture for the portfolio, we are trying to reduce the reduce exposure to stocks where the valuations are on the higher side, especially on near-term valuations, near-term forward valuations. So yeah, at this juncture, this is what we are approaching it. This is how we are approaching it.
Mr. Bhavin, in terms of returns, and what is your outlook for returns in the near term and long term?
So can you?
I'm looking in terms of returns on the markets. What is your outlook in terms of what sort of returns we can expect in coming forward 5-7 years time from now?
So I think, we think returns are an outcome of good investing and outcome of, overall strong economic growth in India. So, I don't want to forecast market returns. I mean, I think people use general rule of thumb that, if the Indian real GDP growth is 7% and then there is 4%, 5% inflation, I think for markets to deliver low to mid double-digit growth over a longer period is not unrealistic. I think historically also, through various ups and downs, Indian market has delivered mid-teens kind of returns, even in dollar terms. So, I think that, so one has to focus on, one, the economic backdrop and what framework, what policies are being decided, what actions are being taken, and then look for opportunities. Even during the period from 2010 to 2014, when Indian economy went through lots of trouble, there were lots of scandals, lots of, companies, banking system having huge and non-performing asset issues and so on. We were able to identify a very, very large number of companies that delivered very high returns. And in fact, my personal portfolio in those periods was up more than 40% on a compounded basis. And it's an audited performance track record. Whereas the market pretty much did nothing. So I think focusing just on the market returns is not something that I would like to do too much. Rather, keep looking for opportunities. India, I think, is a great economy. I think there are so many new sectors that are coming up. The growth is no longer concentrated on a few sectors. And I go back to a study I did in 1996 when I compared India with several markets around the world. And India stood out alongside United States on two parameters: percentage of companies that delivered superior returns on capital, and market's ability to reward such companies in an appropriate way. Now, if you look at the returns from 1996 to 2024, so very long period, India has outperformed every other equity market in the world on US dollar terms. So, and in that period, we have gone through all types of governments, all types of economic, cycles, wars and whatnot, and yet this is the outcome. So, my view is that take a very long-term view on India. I think it's a great equity market, and I can go into why. That would take another half an hour to talk about. But the bottom line is that is far more important than kind of predicting the market returns.
Thank you. Now, Mr. Bhavik, Abans is active in commodities and currency space. And you also have dollar structures that are available both in this segment and also on the growth and momentum portfolio that you run. Can you elaborate on the strategy of the especially the commodity currency space and on the equity space as well?
Sure. So, before I answer that, let me just, give you some statistics. The Nifty was at 12,000 just on 1st of January 2020, right? Just before the COVID hit, we were at 12,000. And, of course, because of COVID, the market fell, right? Along with the global market. And then by October 2021, we were at about 17,000, right? So in about 1.5 years, we went back to almost 30% growth. If you look at the data from October 2021 to March 2023, the index return was negative 3%, right? For 1.5 years, index gave negative returns, right? And from there on, if you see from April of 2023 onwards till now, we are up another about 30-35%, right? So the point, in extension to what others were saying, I think, what is important is that if you are sticking to the asset class, because if you evaluate the performance of your equity portfolio or of a fund manager for this 18-month period, which is October 21 to March 23, you will always get a depressive returns, right? And I think what is important, from superior returns point of view, which is the topic of the discussion today, is that is where the fund managers asset picking and the stock picking abilities will come, right? Otherwise, you'll see that those asset managers will underperform when the markets are just on a one-way trajectory, right? So I think that, a lot of people are also in the distribution business. So I think it is very important. And if you are also personally investing, you should keep this thing in mind. Coming to the question on the dollar product that we offer, so we have been very active in the commodities and currencies market, both in India as well as in the global market. And the fund that we offer through the Mauritius vehicle is Abans Global Arbitrage Opportunities Fund, and basically it's a short-term arbitrage opportunities we explore across the commodities and currencies. So mostly the base metal, precious metal, energy complex, currencies is what we look at. And we look at shorter tenure of the transaction because the fund that we offer is open-ended. And it's a market neutral strategy, right? So just to give you a perspective, during COVID, for the calendar 2020, we delivered about 9.5% absolute return, net returns in dollar terms. And over last 7 years that we have the fund in existence, it has delivered about 8% in dollar terms, right? So I think what is important from an investment management point of view is that are you allocating your money wisely, right? I mean, you will see the equity market world over and in India, you will always see that the markets will go through the cycles, right? But this fund works like a stabilizer, right? Because you will have consistent returns coming in, or some part of your portfolio which you want to allocate to a different asset class. Like a lot of investors who would want to invest in, say, US equities over a period of time. But right now the markets are at an elevated and they think that, okay, I should wait for some time. And that's where they say that, okay, your fund is liquid. I can cash it out at any point in time. So I want to allocate some money to you, right? Similarly, you mentioned about the PMS that we offer, the growth and momentum PMS that we offer, which has a 12-year track record of delivering 23% CAGR and outperforming the index by almost 7% per annum. We started the dollar version of the PMS through our Mauritius vehicle because, I'm sure NRIs can freely invest, right, through PIS account. But opening PIS accounts also have become very, very challenging, right? I mean, a lot of people would have experienced in terms of the documentation that is required and also the annual compliances. Because if you are investing through your PIS account, you are also subject to all your income tax compliances on a regular basis, right? Every year you'll have to file whatever fund manager has booked short-term, long-term capital gain for you. You're supposed to, file your returns and so on and so forth, right? In order to overcome this, the dollar version that we have is that you are investing in dollar currency. The fund is actually investing in Indian market, as an FPI. And therefore, all the capital gains taxation liabilities is at a fund level. What you get in dollar terms is a completely tax-paid income, right? And you don't have to comply with the income tax and the other related stuff, right? So that actually it gives ease of sort of investing, Krishnan. In terms of, you don't have to comply with so many things and there is no evasion, right? I mean, what if you invest in your personal capacity through your PIS account, whatever capital gain, short-term, long-term capital gain that you are supposed to pay, same is the tax treatment for an FPI also, right? Because these are special rate of taxation, right? So that way it helps in terms of quick execution and, not so much of ongoing compliances.
Thank you. Anirudh, how do you blend the seemingly contrasting philosophies of value and growth, investing within your portfolio? And what criteria do you use to decide how to prioritize one over the other? And can you explain your AAID model of your portfolio construct and implementation?
Sure, Krishnan. So as I told you from that research that we did, the most important takeaway was biased free approach towards the market. So if we had to be biased free, then why not we start from the very basic and be bias free in terms of what style of investor we are. So primarily if we look at out there, around 80% coverage would be value, growth, quality, and then safety or debt. So we said that why do we want to do just value, growth, or quality or safety? Why not do all of them together? Can you identify in the markets broadly without timing them based on a multi-factor approach? Is time pe what is the best way to approach the markets? So when there is overall value in the market, by overall value we mean when the markets are oversold and there is a degree of fear in the market, so we go in for value investing. So what does a value investor does? A value investor buys below the intrinsic value, sells above the intrinsic value. So just imagine phase one as what Benjamin Graham used to do. So we do value investing when there is fear in the market. What happens here is that you get good brick and mortar businesses, good blue chips at tremendous discounts. I still remember and I laugh about it. Back in 2020, March closing, when the COVID was at its peak, we had those lockdowns and everything and the markets had collapsed. you were getting Tata Motors at minimum 100 days of price to book since its inception in the Indian markets in the 1980s. So that is the type of opportunities you get when fear takes over. You know, people are just selling mindlessly as markets would finished, and great bets are available. So we are alpha generators. To generate that alpha that we promise our investors, we have to look into these opportunities. So we have developed something called a greed and fear index at Invasset, through which guides us as to what stage we should go in. So it's more based on behavioral sciences, valuations, and stuff like that. So secondly, when the market's there in the new bull run, we go in for the growth investing part. Here, the second most important takeaway from that research was that change is permanent. So we believe that markets are asking one questions again and again. So I'll say it in Hindi that अब तक हुआ आगे क्या. So what has happened is happened. How do you approach? What is your look forward? What are the tailwinds going forward? So we have developed something called a relative change rewarding criteria. We believe that every 3-4 years there'll be a new bull run. In that bull run, it'll be new companies, sectors, or groups that will take over as leaders. That will happen due to something that is change in the broader environment. As a fund manager and investor, our duty is to recognize the change, how big the change is, and how will it translate into top line and bottom line of the companies. Generally, you do not find this change in the top 200 companies that is generally researched by the investors or the fund management fraternity. So you have to go out of your comfort zone, go in for those companies which are not researched well. So we track around 1500 companies regularly on a relative change rewarding criteria. It's just a points based system depending upon what sector you are. And finally, we have 100 companies where the relative change is maximum. Now, these are so either they become boring with time or were not discovered till now, and then our research team goes into the depth and then analyzes these companies, and we choose the top 25 companies in the growth phase. Third, when the markets they become expensive. As today I can say we have completed the transition phase, the markets today in some segments have become expensive. So we go in for quality companies. Quality companies, very easy to understand. The Warren Buffett companies, self-sustainable companies, prudent managements, high return on capital employed, high return on equity, good free cash flows, and generally leaders in the market share or incremental market share, having moats about their businesses. So these companies, what happens is that markets, when they become expensive, they can stay expensive for a very, very long period of time. We saw markets remain expensive from 2018 to, end 2017 to 2020 till COVID stepped in. So markets have a tendency to remain expensive for a very long period of time. The risk reward ratio here becomes okay. If the market, they continue their bull run, 18% is what we are focusing. Even if the markets fall, quality in the 2008 crisis, when the markets fell 60%, the Nifty fell 60%, did not go down more than 20%. So what happens is that when fear sets in, smart money or money throughout the world moves from value or growth to quality. And finally, every 5, 6, 7, 8 years, you find a time where the markets, they become exuberant. Our hypothesis is that we are all investors and not stock market investors alone. And somewhere down the line, preservation of capital becomes very, very important. And we do not shy away from taking bold calls that will move 70 to 80% of your capital into cash and cash equivalents, liquid funds and arbitrage funds when we feel that the markets are exuberant. Yeah, so that is how we manage broadly these four styles of investing, Krishna.
Thank you very much. Vipul, mid and small cap funds have given top performance in 2023. How do you see its momentum moving forward in your future star strategy over the next coming years?
So yes, you're right that mid-cap and small-cap indices have done very well in the last 1 year. And now in terms of just the valuation of these indices, we are in a relatively stretched zone. But having said that, especially when we talk about small-cap market, it's so big that just the index doesn't do justice to all the opportunities that are available in this space. And in any case, there are many pockets right now, mid cap and small cap, wherein there is fair amount of money to be made. And in some instances, we think, based on our research, that the story is just starting. Having said that, one must be aware that this cannot be a linear progression, especially in smaller stocks, small cap, mid cap, all of them. So they do get impacted by market fluctuations, even in the narrow market, if there is a fluctuation. So it's very important to get it right from a fundamental perspective, at least in our scheme of things, that what you are projecting, you have to be very sure what you are projecting in terms of their ability to generate cash, what you are thinking in terms of their ability to get into leadership positions, or to challenge the leaders, existing leaders in the marketplace. So that is very important. Secondly, you also have to be conscious of what you are paying. So just because a stock is looking very exciting from a growth perspective, you should not be reckless. And this is what we are doing. On the other side also, we are saying that just because a stock is looking expensive on PE multiples, we do not reject it, because it also depends a lot on the conviction that you're having on their growth in the near term and slightly medium term, and what kind of tailwinds are they getting from the market. So let's say, for example, I'll talk about a sector, I won't name it, I'll talk about a stock that is there in our portfolio. Right now is trading at fiscal 25, 60 times on PE multiple. Definitely looks stretched, but when I look at the company, talk to their competition, I realize that 45% definitely they are going to grow in the next 2 years, if not more. So if I look 2 years ahead, instead of fiscal 25, if I'm looking at fiscal 26, the P multiple looks 40, which is more acceptable. And 1 year farther ahead, then it's close to 25 times. So it doesn't look stretched. Only the question is, I cannot afford to go wrong in this earnings forecast. And also, one more thing that we do is that we try to balance it. So and again, our facts box approach of portfolio construction helps in this. Basically, if we are having one such stock, I'll need to have some stock on the other end of the value spectrum also, wherein the valuations are not stretched, where in fact they are looking on the other extreme, even if the growth is slightly more modest. So yeah, that's the way we are taking it, and we are quite excited about the Indian markets in general, and also about this mid-cap and small-cap space.
Thank you. Mr. Bhavin, you have now launching your fund in the IFSC. What is your unique investment strategy, and how do you leverage the opportunities that IFSC is going to offer? And how different is it from your domestic PMS? And a supplement question to that is that your fund has given phenomenal returns, say 33% in 3 years. On a 5-year basis, you have done very well. On 8 years also, you have done extremely well. Can you explain the secret of how that strategy has worked for you over this long-term period?
Thank you. So the IFSC or GIFT City, gives an option for investors outside India to participate in our equity strategy, the same strategy that we have for the domestic investors, without having to deal with any Indian compliance. So you don't need a local, Indian PAN, permanent account number, or you don't have to worry about any Indian income tax compliance. You are investing as a dollar investor, and you exit as a dollar investor. Now, because in order to appeal to investors around the world and make this structure more optimal for them, what we have done is made our fees entirely variable. And also there are no direct expenses debited to the fund. All the expenses of the fund are going to be borne by us. So this way, all the fees are variable, and as a result, they can be deducted against the gain and becomes more tax efficient for investors coming from outside India. And is obviously valid, open to either non-resident Indians or foreigners. IFSC in particular offers some additional benefits, in way of lower taxation for dividend and income, which obviously is a smaller part of overall appreciation, but still relevant. And also the derivatives, if there are any, will be tax-free. And so, while our core strategy is to invest in a set of stocks that we see appreciating above our required rate of return over a period of 3 years, we may want to at times participate in, a derivative strategy to enhance returns without taking higher risk, or to reduce the portfolio impact in case of any major calamity, like say COVID or something. So it is participating in our strategy, which has been in place for 8 years, with significant alpha delivered, significant outperformance. Also, our upside capture, in other words, participation in the up market is 115%. If you look at last 5 years, participation in the down market is 60%. So, we have done significantly better in the down market and up market both. So the reason, I think, again, we don't, yes, we do invest with a specific return in mind, depending on the risk of the company, size of the company, because size also is a risk. Smaller companies are inherently more risky. The buying and selling is difficult. There's a liquidity risk. So depending on the risk of the company, we set a required rate of return, and we invest only if we think that the expected return are going to be above those required rate of returns. And these expected returns are derived using very detailed qualitative and quantitative analysis. We follow through a 120-point checklist, before investing in any company. And this is, part of this is also automated. And we basically every investment goes through a review by investment committee, which is myself, a person with a similar experience like me based in US, who's looked at global markets and Indian markets from outside in, as well as two senior members of our research team. And so as a result, there is no single bias that comes into any investment. And I think the Indian equities offers lots of opportunities, to generate superior returns because of the growth of the economy and the quality of the businesses, quality of the entrepreneurs who are running this company. So I think when we follow the rigorous process day in, day out, I think we end up finding ideas that are underappreciated by the market. And as a result, and this minimum required rate of return criteria, which is basically, we are not looking at the market valuations. We are not saying that a particular company in the market is valued at X. So if this other stock is valued cheaper than then buy. That's a relative framework that a lot of people use. We are absolute return focused investor. And so, I think maybe that is a key reason why, we have been able to generate higher returns.
Thank you. Bhavik, how your structured products, market-linked debentures have helped to generate predictable alpha. And I also understand that you have another AIF fund which is mirroring that sort of a strategy. Can you briefly explain that strategy to us?
Sure. So, within the passive investments, like, when I say word the passive, there's been a lot of debate about the active and passive investments, right? And obviously, when we see the large cap mutual fund performance, when 89% of them underperform the market, obviously investors will start to think that, am I better off investing into an index directly rather than, investing into a fund, right? So in that context, what I feel is that market-linked debentures, or what it is known in this part of the world as structured products, becomes predictable passive. And let me just give you some examples in terms of the real products that we have done, right? For example, just day before yesterday on 14th, we launched a product which is linked with the stock of HDFC Bank. Now, just to give you a perspective, obviously, the stock has fallen a lot, right? From a level of about 1,800 to almost it's close to about 1,400, right? Now, so just to give you a perspective, so the product is in 15 months, if HDFC bounces another 15%, you get 175% participation. Means for every 1% that HDFC Bank gives, you get 1.75x. When it gives you 15, you get 26.25% return, right? Which is about 20% CAGR because it's a 15-month return, right? Now, if you think about it, why do I say it is a predictable passive? Is that you may not be able to predict what will the stock growth of HDFC. And for that matter, we do it on Nifty 50 also, right? You may not be able to predict that. But what this product tells you is that for every 1% that HDFC will give, I'll give 1.75, right? And there's a math behind how this returns are generated, right? So I'm in the paucity of time, I'm not getting into how it is made and all of that. We can conduct a webinar on that. But if you think about it, so when the stock is depressed, your objective is to make maximum benefit out of it, right? And as an asset manager, how do we help you do that? It is through this market linked debenture. Actually, SEBI has done a good job of reducing the ticket size to only 1 lakh rupees, right? So resident Indians can freely invest into the product. NRI investors cannot directly invest because it's a privately placed security. So what we've done is that we have wrapped it under a Cat 2 AIF, and that obviously is not available on tap. From time to time, every 3-6 months we come out with new products on this. Just to also tell you, like, for example, recently, you ask any debt fund manager, they will tell you that the interest rates are going to decline, right? I mean, world over, not just in India, but world over. How do you benefit out of it, right? If you invest in a GSEC fund, for example, you will get only 1x of what the interest rate decline will happen, right? If interest rate goes down 75-80 basis points, you will have a corresponding increase in the bond price. But you will get only 1x of that. So we came out with a product. In 2 years' time, if the 10-year GSEC was to decline by another, say, 60-70 basis points, so we started about 715, this is about a month and a half back, and if it was to decline by another 70 basis points, meaning the bond price from 99 was to go to 105, the product gets automatically called off with the capital gain, which is equivalent to 2.65 times. So if the capital gain is, say, 5%, you're getting 2.65 times of that, plus a 7% coupon on that, right? So you make almost 20% CAGR if the 10-year GSEC was to reduce by 70-75 basis points, right? So I think what is important, see, we all have been investing for longest time, right? I mean, everybody understands Indian equities and global markets, and in fact, people here understand more than probably what we do in India, right? I mean, in terms of the global asset location context. What is very important for you choose a right investment manager is that are we able to come out with right set of product at right point in time, right? That is very important because that is the only thing which can differentiate, right? We can launch right product at right time. If you are an investor, you invest at that right time. If you are an asset locator, if you are a distribution channel partner or looking to help your clients, make more money, generate more wealth, you need to choose your investment manager rightly in terms of can this this strategy or can this fund house add value to my client's portfolio, right? So that's been our approach in terms of do innovation. I mean, you have mutual fund, PMS, AIF, all kind of products are there, but how are you innovating and differentiating yourself so that you're able to provide a better solution? That's been our approach.
Yeah, very interesting as well. Anirudh, if in your funds that you manage, how do you source and identify undervalued or under the radar opportunities? And I believe you have an algorithmic approach to evaluate this in considering the market conditions and the economic landscape. So can you give some examples if possible and also explain this process to us?
Yeah. Okay. So very basic and interesting thought that we totally believe in at Invasset is a two-run theory. So what is this two-run theory that has helped us a lot? And I think it should be beneficial for all of you guys. If we look at the last 35 years in the Indian markets, let's start from 1987. We firstly had the Harshad Mehta run. The Harshad Mehta run was more focused on the old economy, ACCs, Apollo Steels, and companies like that. We've all seen it in the web series also. Okay. Then came a bear run which lasted for like 1.5 years till April of 93. From April of 93 to the January of 2000, we had something which we call the new economy run. I'll explain these two runs later, but let me just give you a timeline so that it becomes interesting. So we had something like called the new economy run. So what does a new economy run focuses on? It started from all those quality companies like Hero Honda, and then Hindustan Unilever, and then was finally overtaken by the new thing that was out there, that was technology. Post that, we again had a bear market which lasted for 1.5 years till September of 2001, and then we had a great Indian bull run, which was the India Shining run. You had everything. interest rate sensitives led there. So you had everything from real estate, you had the Unitex of the time, Reliance was the leader, all the Reliance Group companies, and then all those old economy stocks like capital goods like ABB and Aban and all. And finally, then we had 1 year of bear market, which was the 2008 financial crisis. And from 2009 to 2020, we again had a quality run, which focused on FMCG, pharma, and quality lending. And whatever the best performers, the leaders from 2009 to 2020 were more focused on quality. So these two runs differentiation is very, very important. What happens is that in an old economy run, which you have very high growth, you have high inflation. Growth is there, inflation is also high. The money supply is higher, the rate of interest tends to be higher. So while in a new economy run, it's the vice versa. Old economy run, it's focusing on value. A new economy run, it focuses more on quality. Old economy run, so value-oriented sectors like either interest rate sensitives or capex should do well. While in a quality run or a new economy run, all those quality companies like FMCG, pharma, IT, quality lending, white goods, yeah, brands, they should do pretty well. So this differentiation has helped us a lot in generating, alpha. What happens? Why does this happen? Is the main question. What happens is that markets, the stock markets, have a tendency to pick up something from, I would say, dirt and make it super expensive. And then, depending upon the quality and the underlying, either it would have a price correction or a time correction or both, and something other where relative changes happened in those 10 years would perform well. The banking system in India is a prime example of that. Last 10 years belong to quality banking. See, banking is a money lending business. Howsoever good a banker you are, there will be problems in the way you lend. There were very recent cases where money which was being given to retail for buying as a top up on your existing car is being used to invest in the Indian mid and small caps. So ultimately, somewhere down the line, the type of lending you do has to go through a problem. On the other hand, the public sector banks, they had their the entire bypass surgery was done for these public sector banks. The new laws were brought in, they were recapitalized, they were merged. So how we see it as that every 10 years, things change altogether, and you have to account for that change. And could you repeat your question? I missed the second part of it.
No, I'm saying, how does your algorithm model capture this sort of
Yes, so
situations?
how our algorithm captures is that our algorithm is nothing but our experience that we have gained over the past 30 years. It's just coded into a code so that when we are batting on the pitch for you, for our investors, for our prop fund, we are also humans. We also have a tendency to succumb to biases. So you have an elder brother who's talking to you, okay, you have to behave in a particular way. And that is what our algorithm does. We are not those high frequency traders where you are doing a lot of transactions. So what our algorithm does is that depending upon, as I told you, what stage of the market we are in, it just gives us a broad context on how to invest. And historically, in the last 35, 40 years of Indian markets, what type of investing has worked in a particular situation based on a multimodal model.
Thank you. I think we can go on and on to discuss the various facets of returns. But just to put back things in perspective, in the last 10 years, what has also happened is the AIF industry, the PMS industry has also evolved. So that's a big change. So we are seeing a lot of changes happening, whether it is in the flows of FPI, FDI. Today, I think there was a news item to say that domestic flows are now much more than FPI flows. So it shows the India first strategy starting to work. And over the last 10 years, if we have been able to grow from a fragile 5 to a top 5, I think, and we are going to continue to remain there. And if that was the sort of returns that investors have made in the last 10 years, I think going forward, I think it is very difficult to give a call, because the call is going to be extremely optimistic. That is my view. That is the feeling that I get from when we talk to the investment managers and fund managers. The industry is evolved to a great extent in India. And I'm sure as investors, like many people say, that this probably is going to be the golden decade for India from a market perspective in terms of returns. Our panelists are here to talk to you during the day, and you can reach out to them and clarify if you have any doubts, because we don't have time for a Q&A. I thank you all for being a wonderful audience, and I thank the panelists for being to give their point of view and to explain the various strategies that they follow. Thank you very much.